Welcome to our deep dive today.
Okay.
We're going to be exploring the world of quantitative value investing.
Right.
And we're using Wesley Gray's book, Quantitative Value, to guide our conversation.
Okay, great.
So we're on this quest,
Mm-hmm.
We're trying to see if there's is there methodical, data-driven way
Right.
to gain an advantage when it comes to the market.
Yeah.
So we're going to kind of go through this book.
Okay.
We're going to extract the most crucial kind of ideas and insights from this book
Right.
and see if this investing approach could be right for you.
Yeah, it certainly challenges the notion that beating the market is impossible.
Okay.
This method focuses on pinpointing companies
All right.
with a franchise.
Okay.
And these are businesses possessing a sustainable competitive edge
Okay.
that allows them to earn high returns on capital
Okay.
for extended periods.
Okay.
So we're really looking for those special companies
Interesting.
that have that competitive edge.
So we're seeking companies with unique strengths, I guess you could say,
Right.
that set them apart or make them unique in some way.
Correct.
Could you elaborate on this franchise idea a little bit
Sure.
and maybe give us an example so we can kind of wrap our heads around it?
Sure. Think of See's Candies.
See's Candies. Okay.
They were acquired by Warren Buffett.
Oh, yeah. Yeah.
They weren't experiencing rapid growth,
Okay.
but they held remarkable pricing power.
Okay.
Consumers adored their chocolates and willingly paid a premium.
Okay. Interesting.
So this, combined with astute managerial choices, yielded exceptional returns for Buffett,
Wow.
despite relatively modest sales increases.
Okay.
You know.
So it's not necessarily about growth. It's more about
It's more about finding those companies that,
finding those companies with that pricing power.
yes, with the pricing power, the brand loyalty.
That's compelling.
Yeah,
So their success stemmed primarily from their strategic price increases.
mm-hmm.
So it's pretty interesting that they, didn't really see a lot of sales growth, but
Okay.
they made a lot of money by just raising prices.
Right.
What a testament to the power of brand loyalty and a clever pricing strategy, I guess. It begs the question, though.
Yeah.
How do we verify
Yeah.
if a company's reported earnings, right,
Mm-hmm.
accurately reflect its financial health? Could there be some hidden factors at play?
Absolutely. Absolutely. We must be wary of earnings manipulation tactics
Oh, wow.
employed by some companies.
Okay.
Analyzing accruals can help us spot potential discrepancies.
Okay.
Consider it an investigation to unravel the true cash flow dynamics of a business.
Okay.
We really want to know where the cash is coming from and where it's going.
So we're peeling back the layers, basically.
Yes.
We're trying to separate financial reality from a potentially misleading portrayal.
Mm-hmm.
Are there any specific tools or metrics that we can utilize
Right.
to aid in this process?
Indeed. Academics like Sloan and Hirschleifer have developed metrics such as scaled total accruals,
Okay.
or STA, as it's commonly known,
STR?
and scaled net operating assets,
Okay.
or SNOA,
To detect.
to detect potential earnings manipulation.
Okay.
These metrics serve as warning signs, alerting us to possible accounting irregularities.
This reminds me of the infamous Enron scandal.
Yeah, right.
Their financial statements appeared flawless on the surface,
Uh-huh.
right?
Yeah.
But underneath there was this web of manipulation lurking.
Right.
Wasn't there a quantitative tool called the ProBM model
Yes.
that had the potential to detect those manipulations
Right.
well before the company's downfall?
That's correct. The PRBAM model exemplifies how quantitative analysis can cut through deceptive facades and unveil the truth behind a company's numbers.
Okay.
It's akin to having a financial X-ray, allowing us to see the skeletal structure of a company's fiscal well-being.
A powerful analogy.
Right.
And just as a physician uses X-rays, to diagnose issues early on,
Correct.
we can use these quantitative measures to identify potential warning signs in a company's financials.
Uh-huh.
So this brings us to another crucial aspect of investing,
Yeah.
and that's financial distress.
Right.
How can we avoid companies that are kind of teetering on the brink of bankruptcy?
Right.
What safeguards can we implement?
So minimizing the risk of investing in companies facing financial distress is paramount.
Okay.
We aim to mitigate the potential for catastrophic losses that can severely damage a portfolio.
Okay.
Think of it as a risk management imperative.
Right.
We want to really protect ourselves
Right.
from those companies that are headed in a bad direction.
Right. I'm familiar with Altman's Z-score,
Mm-hmm.
which is designed to predict bankruptcy.
Yeah.
Um, didn't it accurately predict WorldCom's collapse,
Yes, it did.
demonstrating the power of these models?
Yeah.
Um, are there other even more advanced models for assessing a company's financial stability?
You're absolutely right about the Z-score's effectiveness.
Okay.
And yes, we can turn to even more sophisticated models,
Okay.
such as the probability of financial distress model or PFD model.
The PFD model called it.
Yeah, and it takes into account a broader range of factors to evaluate a company's financial robustness,
Okay.
giving us a more comprehensive view.
Okay. So we're not relying on intuition or guesswork.
No,
We're utilizing data and advanced models
correct.
to obtain a clear and objective assessment of a company's risk profile.
Uh-huh.
Okay, so shifting gears a little bit,
Mm-hmm.
let's talk about identifying promising companies.
Right.
Does the market itself provide any clues about a stock's potential?
The market indeed offers valuable insights in the form of signals.
Okay.
And signals are actions taken by companies or individuals
Okay.
that offer hints about a stock's trajectory.
Okay.
And one of the most potent positive signals is stock buybacks.
Stock buybacks. Okay.
Yeah.
So if a company repurchases its own shares, does that convey confidence in its future prospects
Right.
and a belief that its stock is undervalued?
That's precisely it. Buybacks often indicate that management perceives the market as undervaluing their shares and sees intrinsic value in their company. It's akin to placing a bet on their own success.
Is it a signal of management's faith in their own company?
Yes.
Okay. Is there any research that supports the notion that stock buybacks correlate with positive returns?
Certainly, certainly. Research conducted by Eikenberry, Lakonishok, and Vermeulen demonstrated a significant correlation
Wow.
between stock buyback announcements
Okay.
and subsequent positive returns.
Okay.
It's like a beacon for perceptive investors.
That's noteworthy.
Yeah.
So stock buybacks, a signal worth noting.
Right.
Are there other signals we should be attuned to?
Insider trading, specifically substantial insider purchases, can be another valuable indicator.
Okay.
When individuals with inside knowledge invest heavily in their own company,
Okay.
it suggests they perceive value that the market may be overlooking.
So it seems like we're deciphering the subtle language of the market. We're learning to discern these valuable hints.
Yeah.
But how do all these pieces fit together into a unified investment strategy?
Okay, good question.
What constitutes the quantitative value approach?
It's about integrating these various elements into a robust, multifaceted approach.
Okay.
The strategy seeks to identify undervalued, high-quality companies.
While simultaneously mitigating the risk of permanent capital loss.
Okay.
It's a balancing act of potential reward
Yeah.
and risk mitigation.
So it's not just about finding bargains, it's about finding undervalued companies with solid fundamentals.
Correct, you got it.
And a history of generating strong returns. Is that accurate?
You've grasped the concept perfectly.
Okay.
The quantitative value strategy blends metrics of financial strength,
Yep.
measures of franchise quality, and attractive prices into a comprehensive system.
Can you elaborate on the specific metrics that comprise this system?
Sure.
What factors are we analyzing?
We examine aspects like the Piotroski F-score to
Mhm.
assess financial strength,
Okay.
consistent returns on capital and steady profit margins
Okay.
to gauge franchise quality,
Okay.
and metrics such as the EBIT enterprise, multiple to pinpoint companies with attractive valuations.
Okay.
So we look at a lot of different things. This is where the intricacies of quantitative analysis come into play, huh?
Yes.
It's a systematic approach to evaluating a company's financial health and potential.
Mm-hmm.
But with such an emphasis on data, how do we avoid falling into the trap of data mining?
Mm-hmm.
Finding spurious correlations that are essentially meaningless.
Right.
You know?
Yeah.
Uh,
That's a crucial consideration.
right.
Remember Lineweber's study
Oh, Lineweber, yeah.
linking the S&P 500 to Bangladeshi butter production?
What?
It humorously highlights the danger of mistaking correlation for causation.
Oh, wow. I bet.
We must be discerning in our choice of metrics.
Oh, that's funny.
Yeah. Yeah.
We want to avoid chasing statistical ghosts
Right.
or relying on metrics that lack true significance.
Okay.
How do we ensure that our chosen metrics have a genuine connection to our investment thesis?
The key lies in selecting metrics that possess a logical link with our investment thesis. We must confirm that each metric boasts a sound theoretical underpinning and a proven ability to forecast future returns.
Okay.
It's a process of meticulous examination and validation.
So it's not simply a matter of inputting numbers into a model and hoping for the best.
No.
It requires careful consideration,
Right.
rigorous testing,
Yes.
and a deep understanding of the underlying financial principles.
Absolutely. Quantitative investing is a blend of art and science, combining data analysis with a sound understanding of financial theory.
Okay.
It's about making informed decisions,
Okay.
not relying on blind faith in numbers.
Okay, great. So we're building, we're essentially assembling this this framework, I guess you could say,
Yes.
based on logic, theory, and empirical evidence.
Precisely. It requires thoughtful deliberation, rigorous testing, and a profound grasp of fundamental financial tenets.
Okay.
We're constructing a model rooted in reason and supported by data.
I'm discerning a recurring theme here.
Oh.
It's discipline,
Yes.
it's prudence,
Mm-hmm.
and it's a healthy dose of skepticism,
Correct.
you know?
Right.
And this leads us to the crucial step of testing our model.
Right.
How can we ensure that it's not just a product of data mining,
Right.
or backtest overfitting?
Mm-hmm.
How do we guard against those biases that can sneak into backtesting and make a strategy appear more effective than it truly is?
We must be scrupulously honest with ourselves
Okay.
and ensure our model can withstand the passage of time and evolving market dynamics.
Okay.
Rigorous testing is paramount.
That's where things venture into a more technical realm.
Yeah.
Right.
Yeah.
We need to be mindful of issues like survivor bias,
Mm-hmm.
look-ahead bias,
Right.
and transaction costs.
All right.
Are these the gremlins that can lurk in our backtesting process?
You're absolutely right. Those factors can substantially distort backtest outcomes, inflating expectations and leading to disappointing real-world results.
Oh, wow. Okay.
We must meticulously account for them.
Could you elaborate on those biases?
Sure.
Particularly the ones to be most wary of when constructing a robust backtest.
Certainly.
But-
Let's start with survivor bias.
Survivor bias. Okay.
This arises when our analysis focuses solely on companies currently in existence, ignoring those that have failed or been delisted.
Okay.
It creates an overly optimistic picture of historical returns.
It's like claiming a stellar safety record for an airline
Right.
based solely on successful landings, right?
Correct.
Without acknowledging any crashes.
Yeah.
We need a complete and balanced perspective
Correct.
to accurately gauge a strategy's true potential.
And an apt analogy. Now consider look-ahead bias.
Look-ahead bias.
Which surfaces when we utilize information in our backtest that wouldn't have been accessible to an investor at the time.
Okay.
For instance, employing restated financial data revised after the fact can artificially inflate returns.
That's like having a crystal ball.
Yeah.
Right.
Right.
And peeking into the future to inform our investment decisions.
Mm-hmm.
Hardly a fair or realistic test.
No.
How do we avoid this pitfall?
We must ensure that our backtest exclusively employs data that was publicly available at the time the investment decisions would have been made.
Okay.
It's about faithfully recreating the conditions an investor would have faced in real time.
So we're meticulously reconstructing the historical
Yeah.
decision-making environment.
Mm-hmm.
And what about those pesky transaction costs?
Right.
Those must be factored in.
Of
or
course, of course.
I imagine they can rapidly diminish returns, especially in a strategy with frequent trading.
You're absolutely right. realistically accounting for the costs of buying and selling stocks is crucial.
Yeah.
Neglecting transaction costs can lead to a significant overestimation of a strategy's profitability.
It seems we can't simply assume that we can buy and sell stocks at the precise prices reflected in our back test.
Right.
Right.
No.
We need to incorporate those real-world frictional costs.
Yes.
It's all about creating a realistic simulation.
Indeed.
Okay.
Backtesting, while a valuable tool,
Okay.
is not a magic bullet.
Okay.
It requires a nuanced understanding of its limitations and potential pitfalls.
This has been a truly illuminating discussion.
Yeah.
I'm gaining a deeper appreciation for the complexities of quantitative investing. It's not simply about crunching numbers.
No.
It's about crafting a robust framework
Right.
that can withstand scrutiny.
You've captured the essence of it.
Yeah.
Quantitative investing is a blend of scientific rigor and an appreciation for the inherent uncertainties of the market.
Right.
Yeah.
Okay.
Welcome back to our exploration of quantitative value investing.
Thanks.
It's vital to acknowledge the psychological element of investing.
Okay.
It's often overlooked,
Oh, right.
but profoundly impactful.
Interesting.
Emotions can sway our judgment,
Oh, I see.
prompting impulsive choices
Mm-hmm.
that erode returns.
Okay.
I
Absolutely.
mean, we're human.
Fear and greed can be powerful forces, especially when market volatility surges.
Right.
How can we navigate these emotional pitfalls and make more rational, data-driven decisions?
A systematic approach
Okay.
offers an invaluable solution.
Okay.
It helps us detach from those emotional roller coasters and anchor our decisions in data and logic.
Okay. So it's all about having some rules, I guess.
Correct.
Okay. And sticking to them, right?
Remember the simple checklists
Checklists. Okay.
utilized by surgeons?
Oh, are you referring to those stupid little checklists, as Atul Gawande called them?
Yes.
That
Yeah.
that drastically reduce errors in surgery.
Correct.
The ones that have been proven to save lives.
Exactly. Exactly.
Wow. Okay.
Those checklists are equally potent in the investing realm.
Oh, interesting.
And they ensure we consistently apply our chosen criteria,
Okay.
preventing biases from creeping into our decision-making process.
Mm-hmm.
It's akin to having a reliable co-pilot to guide us through turbulent market conditions.
A fascinating parallel. So instead of succumbing to market whims
Right.
or chasing speculative tips, we establish a disciplined process.
Correct. A set of rules to steer our actions.
Okay. This resonates with me.
Good.
Can we delve a bit deeper into the construction of the quantitative value model?
Sure.
How do we go about selecting the specific metrics? The universe of financial ratios and data points seems vast.
Navigating that sea of data can indeed be daunting.
Right.
Recall Lineweber's whimsical study
Lineweber, yeah.
linking the S&P 500 to Bangladeshi butter production.
Right, right.
It underscores the need for caution in choosing metrics,
Okay.
ensuring they genuinely relate to our investment goals.
We certainly don't want to end up chasing statistical mirages.
Right.
Or relying on metrics that are essentially hollow.
Correct.
How do we ensure that our chosen metrics have a legitimate connection to our investment thesis?
The key lies in selecting metrics that possess a logical nexus
Okay.
with our investment thesis.
Okay.
We must confirm that each metric boasts a sound theoretical underpinning and a proven ability to forecast future returns.
Okay.
It's a process of meticulous examination and validation.
So it's not as simple as throwing a bunch of numbers into a model and hoping for the best.
No, it's much more involved than that.
We're essentially assembling a framework based on logic, theory, and empirical evidence.
Precisely.
Right.
It requires thoughtful deliberation,
Okay.
rigorous testing, and a profound grasp of fundamental financial tenets, where we're constructing a model rooted in reason and supported by data.
I'm discerning a recurring theme here.
Okay.
It's discipline.
Yes.
It's prudence.
Uh-huh.
And it's a healthy dose of skepticism.
Correct.
This leads us to the crucial step of testing our model.
Right.
How can we ensure that it's not just a product of data mining or backtest overfitting?
We must be scrupulously honest with ourselves
Okay.
and ensure our model can withstand the passage of time and evolving market dynamics.
Okay.
Rigorous testing is paramount.
That's where things venture into a more technical realm, right?
Yeah, yeah.
We need to be mindful of issues like survivor bias,
Mm-hmm.
look-ahead bias, and transaction costs.
Correct.
Are these the gremlins, I guess, that can lurk in our backtesting process?
You're absolutely right. Those factors can substantially distort backtest outcomes, inflating expectations and leading to disappointing real-world results.
Oh, wow. Okay.
We must meticulously account for them.
Could you elaborate? Could you elaborate on those biases,
Sure.
uh, particularly the ones to be most wary of when constructing a robust backtest?
Certainly, let's start with survivor bias.
Thrower bias. Okay.
This arises when our analysis focuses solely on companies currently in existence, ignoring those that have failed or been delisted.
Okay.
It creates an overly optimistic picture of historical returns.
It's like claiming a stellar safety record for an airline,
Right.
based solely on successful landings,
Oh,
right?
correct.
Without acknowledging any crashes.
Yeah.
We need a complete and balanced perspective to accurately gauge a strategy's true potential.
An apt analogy.
Yeah.
Now consider look-ahead bias,
Look ahead bias,
which surfaces when we utilize information in our backtest that wouldn't have been accessible to an investor at the time.
Okay.
For instance, employing restated financial data revised after the fact can artificially inflate returns.
That's like having a crystal ball,
Yeah.
right? Peeking into the future to inform our investment decisions.
Mm-hmm.
Hardly a fair or realistic test.
No.
How do we avoid this pitfall?
We must ensure that our backtest exclusively employs data that was publicly available at the time the investment decisions would have been made.
Okay.
It's about faithfully recreating the conditions an investor would have faced in real time.
So we're meticulously reconstructing the historical decision-making environment.
Yes, sir.
Okay. And what about those pesky transaction costs?
Right.
Those must be factored in, right?
Of course, of course.
I imagine they can rapidly diminish returns, especially in a strategy with frequent trading.
You're absolutely right. Realistically, accounting for the costs of buying and selling stocks is crucial.
Okay.
Neglecting transaction costs can lead to a significant overestimation of a strategy's profitability.
It seems we can't simply assume that we can buy and sell stocks at the precise prices reflected in our backtest.
Right. Yeah.
Right.
Yeah.
We need to incorporate those real world frictional costs.
Yes.
It's all about creating a realistic simulation.
Indeed.
No, yeah.
Backtesting, while a valuable tool,
Okay.
is not a magic bullet.
Okay.
It requires a nuanced understanding of its limitations and potential pitfalls.
This has been a truly illuminating discussion.
Okay.
I'm gaining a deeper appreciation for the complexities of quantitative investing.
Uh-huh.
It's not simply about crunching numbers.
No.
It's about crafting a robust framework that can withstand scrutiny.
You've captured the essence of it. Quantitative investing is a blend of scientific rigor and an appreciation for the inherent uncertainties of the market.
Right. So as we embark on kind of the final leg of our deep dive into quantitative value investing,
Right.
I'm eager to kind of revisit that intriguing question we posed earlier.
Okay.
Can a purely quantitative approach
Mm-hmm.
genuinely rival the performance of legendary value investors?
Right.
It's the ultimate test, pitting human intuition and experience
Right.
against the cold calculating logic
Mm-hmm.
of a data-driven model.
To address this question, we pitted our quantitative value strategy
Wow.
against 3 highly regarded value investing mutual funds:
Okay.
Sequoia Fund,
Okay.
Legg Mason Value Trust, and Third Avenue Value Fund.
Okay.
Each with a lengthy and impressive track record.
So we're talking about titans in the value investing arena.
Yeah.
Funds helmed by individuals who've dedicated their careers to refining their expertise and establishing their reputations.
Correct.
How did we level the playing field, so to speak,
Yeah.
for a fair comparison?
To ensure a robust comparison, We incorporated hypothetical management fees
Oh,
and trading expenses for our quantitative value strategy,
okay.
aligning it with the realities of those actively managed funds.
Gotcha.
We aim to create a realistic simulation of how these approaches would fare for an actual investor
Right.
over an extended time frame.
That makes sense. It's
Yeah,
not it's
yeah.
not merely a theoretical exercise. We're replicating real world conditions.
Correct.
What time frame did we analyze, and
Yeah.
what criteria were used to evaluate performance?
We examined a 20-year period,
20 years?
scrutinizing both absolute returns and risk-adjusted returns,
Okay.
measured by the Sharpe ratio, which considers the trade-off between returns and volatility. We also assess downside protection, gauging how each approach weathered market downturns.
All right. Enough with the buildup.
Okay.
Reveal the findings. Did our quantitative value strategy hold its own against these seasoned veterans?
The results were quite compelling.
Okay.
Even with the inclusion of those added expenses, the quantitative value strategy surpassed all three funds
Wow.
in terms of risk-adjusted returns, exhibiting a superior Sharpe ratio.
Well,
Furthermore, it demonstrated greater resilience during market declines, experiencing smaller drawdowns compared to the funds.
that's a fascinating outcome.
Yeah.
It suggests that a systematic, data-driven methodology can potentially yield superior results,
Right.
even when measured against some of the most accomplished investors in the industry.
Mm-hmm.
Does this imply that human judgment is no longer relevant in investing?
Not necessarily.
That's
While
right.
while these findings highlight the power of quantitative analysis and its capacity to unearth opportunities that might elude even the most astute human analysts,
Right.
it's essential to remember that human judgment remains valuable.
So it's not about replacing human judgment altogether, but rather leveraging the strengths of both approaches.
Right.
Is there a way to blend um, quantitative analysis with qualitative insights
Yes.
to forge an even more potent investment strategy?
Absolutely. A hybrid approach
Okay.
where quantitative models furnish a foundational framework
Okay.
and human analysts then apply their experience and discernment to refine the selections
Okay.
could potentially lead to even more favorable outcomes.
That makes intuitive sense. It's about recognizing that each approach possesses its own merits and limitations, and by combining them, we might unlock truly exceptional results.
Mm-hmm.
So as we conclude our deep dive into the realm of quantitative value investing, I'd like to kind of distill the key takeaways for our listeners.
Yeah.
What are the most crucial points they should retain from our conversation today?
Firstly, remember that pinpointing companies with enduring competitive advantages,
Right.
those franchises we discussed, is paramount.
Okay.
Seek out businesses possessing a distinct edge that empowers them to consistently outperform their competitors.
Right.
It's about identifying companies with the potential for sustainable success.
Yeah, it's about more than just finding inexpensive stocks.
Correct.
It's about unearthing companies
Yeah.
with a robust foundation for long-term growth and profitability.
Exactly.
What other insights should listeners keep in mind?
Secondly, never underestimate the significance of meticulous financial analysis.
Okay.
Thoroughly examine those financial statements, searching for any warning signs
Right.
that might hint at earnings manipulation or financial distress.
Right.
The numbers narrate a tale, but we must be adept interpreters
Mm-hmm.
to decipher it accurately.
And as we've discussed, those quantitative metrics can be immensely valuable tools
Yes.
for discerning the truth behind the numbers and separating genuine performance from financial illusions.
Correct.
What else should investors bear in mind as they're going through this process?
Thirdly, be attentive to the signals emanating from the market.
Okay.
Actions such as share buybacks and insider purchases can offer valuable clues about a company's prospects
Right.
and whether the market might be mispricing its shares.
Right.
Develop the skill to interpret those signals
Right.
and leverage them to inform your investment choices.
It's like mastering a secret code
Yeah.
that can unlock hidden investment opportunities.
That's a great way to put it.
Any final words of wisdom for our listeners?
Fourthly, embrace a systematic approach to investing.
Okay.
Cultivate a disciplined process.
Okay.
A set of rules grounded in sound financial principles
Well-
and adhere to it steadfastly.
Okay.
This practice can help you circumvent emotional pitfalls
Mhm.
and make more rational, data-driven decisions, enhancing your chances of investment success.
Indeed, having a checklist
Yes.
much like those employed by surgeons,
Right.
can prove invaluable in maintaining consistency
Yeah.
and mitigating the impact of cognitive biases
Exactly.
that can cloud our judgment.
Right.
Any concluding thoughts before we wrap up?
Finally, keep in mind that even the most sophisticated quantitative models are not infallible.
Okay.
Backtesting offers valuable insights but doesn't guarantee future success.
Right.
Investing inherently involves uncertainty, and we must be prepared for the inevitable market fluctuations along the way.
Right.
It's a journey marked by both triumphs and setbacks,
hmm
and we must equip ourselves with the knowledge and tools to navigate it effectively.
This has been an incredibly enriching exploration of quantitative value investing.
Good.
I trust our listeners have gleaned valuable knowledge
Okay.
and perhaps even a fresh perspective on the world of investing. Thank you for joining us on the deep dive.
It was a pleasure being here.
And until next time, may your investment endeavors be fruitful.